Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner and founder of Menninger Associates Financial Planning. I'm pleased to have joining me today Nick DeVito, who is also a certified financial planner and one of the associates of my firm. Thank you for joining me again.
Thanks for having me.
This is part two of an episode that we're doing case studies. Case studies have been popular demand. We're seeing a lot more activity for people on the YouTube and iTunes and all the different media with which you can access these. People really like it, and we're actually getting a lot of feedback from people watching these episodes or listening to them. So we're finding too, a lot of people are listening. Mm-hmm. So therefore, when they're listening, slides are meaningless.
Yeah, that's
so we're trying to be cognizant of not showing everything all the time. So therefore, for the benefit of all of you who are listening only, we'll try to reiterate some of the facts of the case where it's kind of fresh for when we pick up and talk about it. Okay? So real quick, we have is a husband and wife. Husband 60, the wife is 65. Both of them were in corporate America, and a few years ago, they left corporate America and started up a franchise. And with that franchise, they're paying themselves, there's an S Corp, they're paying themselves a salary, and what they have for assets, generally speaking, is they have $1 million in IRA assets, $1 million in non-qualified investment assets, stock, which have $500,000 in unrealized capital gains. They have two properties, a primary residence worth about $1 million, and then a vacation home worth about $500,000. And then on each property, they had about a $200,000 mortgage, reasonably low interest rates. And then they also had a home equity line of credit with $100,000, not quite as reasonably low. So where we left off on the last episode is we were talking about the tax planning. So that was a jaw dropper, okay? To your point, every time we meet with someone, we like to gather information, but one of the pieces of information, aside from pay stubs, that we find to be an extraordinarily valuable piece of information was their tax return, and it was a jaw dropper.
Yeah, just as a refresher, they had a negative $23,000 taxable income for 2023.
Right,
and so jaw dropper he's referring to.
Right, and so the reason why it's a jaw dropper is because here I'm trying to unwind $1 million IRA because we know it's going to get taxed to them. How can we make it so that it's taxed at its lowest rate? And then secondarily, we got $500,000 in long-term capital gains. How can we sneak that out? And what happened was with a $23,000 negative $23,000 taxable income, they could have effectively taken about $115,000 in capital gains last year and paid no tax. Or they could have taken $115,000 out of their IRA or converted it to a Roth IRA and paid 10%, which would have been about an 8% tax, which is ridiculously low.
Yep.
And substantially lower than what they will be paying in retirement. So again, here's the goal of what we do. What we try to do with every single client that we meet is we try to understand what their goals and objectives are. We take the facts of the situation, we try to match the two, and we try to do it in a manner with which is tax efficient, but also flexible.
Oh yeah, I mean that's one of the biggest components of any financial plan is you want to build flexibility in there. That's why we get the HELOC. That's a tool, a flexibility tool. That's part of the reason with the Roth conversions. It's flexibility, managing your income in the future.
That's correct. So we'll pick up kind of where we left off. So we anticipate, and so we had the opportunity to meet with their accountant with them.
So to Mike's point, last year's water under the bridge.
Right.
What can we do moving forward? So taking a look at this year, their AGI, which is adjusted gross income, is going to be right around $100,000. So what are the things that are going through our head? We're looking at, should we take capital gains? Like we said, they have $500,000 in long-term capital gains. Should we take some of them? Do we want to do Roth IRA conversions? And we're always cognizant of IRMA, which is the income-related adjustment amount, or income-related monthly adjustment amount.
Right. I always call it the income-related monthly attitude adjustment because of the fact that when you're paying this, you need an attitude adjustment.
Yeah, so what it is if you're on Medicare and your income is above a certain threshold,
Right.
there's this additional charge for your Medicare premiums.
Right.
And it's essentially a tax when you really get down to it. You're paying more for your Medicare based on your income. So it's
Right.
essentially a tax.
Exactly.
So we're always cognizant of that when we're planning for someone that is on Medicare or will be on Medicare in 2 years, because there is a 2-year look back for it.
Right.
So we always have to be cognizant of that. And that's kind of some of the things that we're thinking of when we're saying, let's do some tax planning for this year. What are the opportunities we can take?
But the interesting thing about them, okay, is Charlotte is on Medicare, but Jack isn't.
Yep.
Okay, Jack is 60. So he's not going to be on Medicare for 5 more years, which means that it's not going to be until 3 years from now are they looking at their income to implicate him for additional
Yep.
Medicare premiums. So what you find is if you take a look at the different brackets, first of all, unlike the tax brackets, where if you exceed a certain threshold of a tax bracket, it's only that little bit that you're paying the higher tax on. Medicare is what's referred to as a cliff. And what happens is that if you exceed that income threshold by $1 stinking dollar, then what happens is that you each end up paying something to the tune of $60 or $80 per month extra Medicare premiums. Now, if you take a look at the brackets, use these examples. If it turns out that your next threshold jumps by $50,000, meaning, what do I mean by that? Let's try to explain myself. If the first threshold is $210,000 before you end up having to pay extra Medicare premiums, and the next threshold is $260, that means you go $210,001. It's the same as if you're $259,999. Okay, so basically you got $50,000 in there of additional income, which is going to impact Medicare premiums 2 years from now by about $1,000 a month. $1,000 a year. $80 a month. It's just like, all right, $1,000 divided by 50, that's 2% per person. So if there's 2 people, that's 4%. So we look at that as a 4% tax. But in this case, we know it's lurking out there.
Yep.
So we say, all right, there'll be a 2% increase instead of 4.
Yeah.
We're doing it at the time that the tax brackets are lower than they'll ever see again.
Mm-hmm.
So we may as well take advantage of it because we have to basically get out of we're unwinding.
Yeah.
Okay. They have no Roth IRAs. Therefore, we haven't even started their 5-year time clock. Mm-hmm. Okay. So these are all the things that we've got going on in our heads. Okay. Not to mention that because the tax brackets are going up, or at least scheduled to go up in 2026, the tax brackets are only going up for the ordinary income rates.
Yep.
Not capital gains rates.
Mm-hmm.
So one of the things that we are looking at is, hey, let's take advantage of the ordinary income rates now, because in 2 years the capital gain rates. But then we're juggling chainsaws that are on fire.
Well, yeah, because we needed to create liquidity for them.
We create liquidity.
So-
we wanted to pay off the line of
We
credit.
wanted to diversify. So what we ultimately ended up doing for them is we took a boatload of capital gains.
We did.
And we stayed within the 15% capital gains bracket. So just so, if you're not familiar, a long-term capital gain is on an investment that you've held for a year and a day. If you've held that investment for a year and a day before you sell it, it qualifies for preferential tax treatment that will always be lower than whatever your ordinary income tax bracket is. So capital gains are taxed at either 0, 15, or 20%. We've made sure to keep them within the 15% bracket, so we only paid 15%
Right.
on those capital gains.
Right. Okay. So these are some of the things that we're thinking about. Now, let's talk about the investments. So you made reference to the investments of selling off the investments, because we wanted to at least, we were trying to kill 3 stones with one bird. Mm-hmm. Okay. We're trying to diversify, we're trying to utilize and take the capital gains, and we're also trying to create cash.
Yes.
Because we wanted to be able to use it to pay off. And the diversification it was just basically reducing the over concentration in a particular stock. And it's kind of funny how it worked out.
Yeah.
So we were able to get their cost basis for each of the stocks. So let's just focus on the one, because the one was the one that we were most concerned about, because 45% of their they're non-qualified.
Yeah, they're
assets.
not qualified.
45% of it was in one company's stock. That's too much. But then if we looked at it, we had capital gains going all the way back to like 2004.
Yeah, maybe even before that. It was very early 2000s.
Right. So when a stock's just climbing like that, he had 600% gains on his stock that he purchased 20 years ago. Okay.
And, anytime we're selling an investment in a non-qualified account, we're always looking at the individual lots of shares.
That's correct.
So we can go in there and say, we're selling 1,000 shares. I want to sell 500 from this lot, 400 from this lot, and 100 from another lot. We're always very conscientious of that, just because that's, once again, the way we maximize tax efficiency and pick and choose what we actually
Correct. And so what we're trying to do is maximize the number of, trying to reduce the concentration in the stock. And, if you got, let's say, 10,000 shares of a particular stock, and you could sell 2,000 and get a $50,000 gain, but a different 2,000 generates 150,000 in gain, you want to try to minimize the gain. Because, the other thing that comes into play is the potential step up in basis if somebody dies.
Yep, absolutely.
So if he were to die, basically, whoever his beneficiary is that inherits the asset inherits as if the capital gain goes away, is basically the long and short of it.
Yeah, so for anything that we sold and we didn't use for cash, that's when we were really looking to diversify. Anything we sold and didn't use to pay down the HELOC or the primary residence mortgage, that's where we look to diversify. Anytime you're looking at assets or you're managing investments, you're really looking at the time horizon.
Correct.
When are you going to need these funds? If you're going to need them in a year or two, well, then we don't want to take any risk on that. If you're going to need them in 2 to 5, you can take some risk, maybe in the form of bonds. 5 to 10, maybe some safe stocks. 10 plus, you can afford to take the risk. So maybe you can go a little bit heavier in stocks for those allocated assets, if you will. So that's really what we did for them. Once again, referring back to last episode, they had a lot of money sitting in just cash.
That was in the IRAs, though.
Specifically in the IRA. So when we're looking at their overall portfolio, and the IRA is a component of that. So they had 100% cash. We said, let's do something about that. Let's have that money work a little bit harder for you.
Right.
And that doesn't mean jumping all into stocks, but we put some in stocks and some in bonds just to increase their exposure there.
We also dollar cost averaged it too.
Yes. Yeah.
Okay. And dollar cost averaging, works really well when there's volatility in the markets. And similarly, if the markets are on their way down, you're not jumping in all at once. You're buying in, and if the share price is high, you're buying less shares. Share price is low, you're buying more shares. Ends up being, when you dollar cost average, the average share price you paid is always less than or equal to the average share price in all those dates.
Yep.
But it allows people who are loaded with cash not to jump in all at once, because the last thing you want to do is jump in all at once and have everything go down.
Absolutely. Yep.
So we took care of that with their IRAs. We were also taking a look at what their time horizon was, et cetera, and we're balancing act. We're balancing act on the taking care of reducing their concentrated stock positions, trying to take advantage of creating liquidity to pay off. Then we're trying to do the Roth conversions, and then we're trying to rebalance all of their IRA accounts to be a more diversified portfolio than all cash.
And I think that's why it's so important to be looking at the whole financial picture, not just the investments, not just
That's
the
correct.
taxes. And that's what we really try to do. Is it's a holistic approach to financial planning. We're not just looking at the investments individually, because you can't do that if you want to be efficient.
Right. It's not just efficient. You want to be good.
Yeah. Well, yeah. Exactly.
You're being nice.
Yep.
All right. So what else we got? Now we're talking about the retirement planning. And that always, there's like, hey, would we be able to retire? And we like to ask them the question, if we are able to ascertain, which we did. Okay, we kind of asked them, hey, what's your cost of living? And before we actually met with them, the second time, we were able to run the retirement income models and saw that they were going to be okay.
And it kind of, one of the biggest questions we get when people walk in the door that are approaching retirement is, can I retire? When can I retire?
Right.
And there's a lot of that goes into that. It's not a black and white scenario. One of the single biggest components, I would say, is the cost of living. How much you want to live on in retirement? That's really the driver for the rest of the retirement plan, because if you're telling me you want to live on $1,000 a month, I'm exaggerating there a little bit, well then you don't need much to retire. If you want to live on $20,000 a month, well, you're going to need a little bit more to retire.
Right.
So it's really just kind of juggling that. Some of the other things we're thinking of, specifically for those that are not age 65 before they retire, is healthcare. How are you going to be covered from whatever you retire at at age 65?
Right, that's correct.
At which point you can hop on Medicare. For them, it was kind of a unique situation. I don't want to say unique, but one was on Medicare, one wasn't. got to kind of juggle that as well. Social Security, we'll talk a little bit more about that, but that's obviously a big component of retirement planning. When should you start collecting? Who should start collecting first? Do you want to let one benefit grow so that the spouse can take one half of a higher number? There's a lot that goes into that. Taxes, as we always say, are also a very important component of a retirement plan. We're always thinking about taxes and maximizing tax efficiency now and in retirement. And then what are their other incomes? For them in particular, they had pensions lurking out there, so what do we do with those pensions? Do we take the lump sums? Do we do the monthly distribution, monthly payments?
Yeah.
That's really all.
Can we play that all out?
That goes into that, but that's just kind of some of the things that we're thinking of when someone asks us that golden question of when can I retire?
And the beauty of them is, as business owners, they got a lot of control.
Oh, yeah.
Okay, and so we came up with a pretty nifty solution for the Social Security, which we'll share. All right, so I guess we're right on it.
Yeah.
So what happened here is we're taking a look at the Charlotte 65 and Jack.
Yep.
Jack is 60. But what we did is we looked at their, I would have liked for it to be in reverse.
Yeah, I know.
Okay. However, what we usually will do is we want to see who gets more. Okay. Jack's benefit is actually higher than Charlotte's. Okay. Which means that what you want to do is you want to leverage Jack's, and then you want to take Charlotte's as soon as possible. Okay. So if we look at one person all by themselves, we're in the camp that you're better served to take it as soon as you can, from purely the financial numbers perspective.
Looking at the break-even age.
Right, looking at break-even ages.
That break-even ages.
But when you have a spouse, what happens is if one spouse dies, the surviving spouse gets to choose the higher of the two. So if you've got Charlotte, who is the lower of the two, start taking hers.
Yep.
Because of the fact that if the husband dies, if Jack dies, she automatically jumps from hers to the higher number. Yeah. And then what we'll do is we'll take the higher number and let it grow more. Now, here's the beauty of it, is they have the ability to control their income because they're an S-corp.
Yep.
Okay, they're an S-corp, they're business owners. So what we said is, hey, look, you know what? I don't remember. I think they weren't really paying Charlotte that much.
Yeah, she had a very low salary. And that's one thing to consider when you're doing Social Security is if you're collecting Social Security before full retirement age, there's income limitations.
That's correct.
Or else you will be reduced on your Social Security. So that was another component of that kind of worked out nicely.
It worked. It did work out nicely. So what we did is we're actually now having Charlotte take her Social Security immediately, and we're giving the accountant the ability, and we had this discussion with the accountant, and they're fully in agreement. It's debatable as to do we pay her? She can earn about $22,000 a year. But you know what though? Fact of the matter is that doesn't help her, because if you take a look at what her full retirement age income is based upon her average of her highest 35 years, when we're throwing $20,000 a year in, she's getting no benefit.
Yeah.
It's not adding to her benefit.
Yeah, exactly.
It's only a stinking tax.
Whereas Jeff, if we're paying him, I think the $65,000,
Right.
That is helping his average there. So it's jacking up his Social Security.
I don't think it was.
I think it was a little bit.
Was it?
There was some.
Okay.
Yeah, that was part of the consideration that we were.
Yeah, so, I mean, if we can jack his up and then let's shift all the income to him, okay? Or not shift the income at all, allow it to be a profit,
Yeah.
which is a whole brand new thing, because then you've got the reduction in how much you're contributing to Social Security that has little to no bearing on their benefit. And then secondarily is it increases the qualified business income deduction. It's just so many advantages. Yeah. So these are the things that we were taking a look at. Now, just realize we're up against break. So what we're going to do is we're going to be back with you in just a few moments, and then we'll pick it up and we'll wrap up this particular case study. So stay tuned. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained, and we are continuing the final segment of a case study with Jack and Charlotte. We're wrapping up. We were talking about, this is a tax planning issue.
Yep.
That, it's funny, it wasn't an issue until we got involved, because it's remarkable how many people don't realize they have an issue until we bring it up.
Yeah, and it's one of those first world problems.
Again.
We say issue, it's a missed opportunity. Is it the end of the world? No, but you can be.
Well, if we could save people tens of thousands of dollars in taxes,
yes,
it's an issue.
So, yeah, I agree.
So anyway, so more to it. There was a few pretty cool opportunities that popped up here. We're like, well, wait a minute, you got a business. Why don't we establish a 401k? Okay, they have no 401k and they have no retirement plan through the business. And we figured, okay, if we establish a retirement plan through the business under the new rules of Secure 2.0, they get all kinds of tax credits for the establishment of the 401k, et cetera, okay? Wonderful, terrific idea, but it just so happens that they only have 2 employees, aside from themselves. One of them is a 1099, so it's not really an employee. And the other one, which is a W-2, is being called to active duty because he's on reserves, is being called to active duty. He's not going to be...
He'll be out for all of next year.
Right, so it does no value to them from that perspective. Now, the only value it does provide is it provides them the opportunity to slam their 401k. And given that they weren't really able to capitalize on all the benefits of a 401k, we agreed it didn't make sense.
Yeah, we went through the whole process. We kind of took a look at the cost. The Secure 2.0 has made starting up a 401k, if you have enough employees, essentially free.
Right.
Not too many employees. There's kind of ranges if you're at 50 or less employees. But if you have a certain number of employees, really depends on the situation and what TPA service you're using and record keeper and all that fun stuff for the actual 401k. You can essentially start it for free. So we were kind of operating under that. Then we ran the numbers and said, okay, it is actually going to cost you. It's not going to necessarily be free.
Right.
So does it make sense?
And mainly because of the fact that the 401k would have only been serving the business owners.
Exactly.
And they don't get some of the benefits. Like matching contributions are credits. Startup is a credit, but they missed out on a lot of that. And then there was a tremendous hassle associated with setting it up and record keeping and all that. We decided jointly to scrap it.
Yeah.
But hey, it was a great idea.
Yeah, it's something we always consider when we're dealing with a business owner, especially since Secure 2.0 come out, because that 401k does provide a lot of flexibility if you are a business owner. You can really put a lot of money away on the pre-tax side, traditional if you need to, or on the raw side if you need to, whatever makes sense for your situation.
But it just, again, so we laid out all of the advantages, and the advantages that it provided them were not great enough to warrant doing it. So we bagged it.
Yep.
And,
that's okay.
We just
we were thinking about it. It didn't happen to work out for them, but hey, we thought about it, and it was a consideration we made.
Right. So then we took a look at their pensions.
Yep. Yeah, so they wanted us to take a look at their pensions. They essentially came to us and said, what should we do with these? So if you look at it, Charlotte had 2 pensions, one with a $38,000 lump sum that would pay about $260 a month, and then one that was a $15,000 lump sum that would pay out $80 a month. Then Jack also had a pension lurking out there with a $180,000 lump sum that would pay a little over $1,200 a month. So really what we're looking at with pensions, there's a few things that go into it. Comparing the lump sum versus the monthly, what makes sense from that standpoint. There's a level of a hassle factor to it, especially when you're dealing with a lower monthly payment. Do I want to take a pension that's $60 to $80 a month, and if I change banks, then I got to go change the bank on the pension? Right. Is it really worth having to worry about that and upkeep it for $60 a month? And same with the $260 a month.
Right.
And what we ultimately decided for her was, let's just do the lump sum. We'll put it in your IRA. You can invest it how you want. And the lump sum does provide a level of flexibility. Because, for example, for his $1,200 monthly payment versus the $180,000 lump sum, one thing we always talk to people about is, do you need this income in retirement? Are you going to be counting on this $1,200 a month? Because you kind of have 2 options with that. You can say, okay, you can essentially create your own pension, if you will, from your IRA. We resend you $1,200 a month
Right,
from your
exactly
IRA. So
right.
you can
Tax the same way.
You can tax the same way. You can kind of mirror that process, but then it also provides you the flexibility of, well, this month I don't need $1,200, so we don't send it to you that month. Or this month I need $2,000. You can really, it builds in flexibility, which is something we always aim to do in any financial plan.
Correct, and not to mention that you can set up a pension to have your spouse be the contingent if you pass away. Okay, and then you can always reduce it, based upon how much you leave in 25, 50, 75, or 100%, and it reduces it accordingly. But then upon the death of the second spouse, money's gone.
Yeah.
Okay, so a lot of times people will take a look at what their longevity and life expectancy are, and they have children. It's like, I'd like to leave some of this behind for my children. They'll just say, give me the lump sum. Yeah. Particularly when it's small dollar amounts. My goodness. Yeah. Is $80 a month going to make a difference in your life? And the answer is usually no. Now, the one as it pertained to Jack of $1,200 a month, we have these discussions with others and we say, hey, look, you know what? You got $1 million in IRA assets. $1,250 a month is a number that's meaningful.
Yeah.
Okay. And what it does is instead of it being $180,000 that we're adding to the $1 million IRA, what it is that it's providing some amount of their overall IRA is guaranteed. Mm-hmm. They're getting the $1,200 a month for the rest of their life. It's not at risk. They're effectively transferring the risk onto the insurance company that is backing the pension.
Absolutely.
And so there's a lot to be said about that, not to mention combined with Social Security, between their two Social Securities and the pension, not just them, that may be enough to get most of their cost of living through retirement, whereby it's only an excess that they reach in. For instance, if your mortgage is paid off, well, you don't need the money every month, but come August, now you got an $8,000 tax bill. So those are the types of things that the IRA provides, or going on vacation or things like that.
And there's a psychological component too. Some people like knowing I'm getting $1,200 a month for the rest of my life.
Right.
And some people also don't like dipping into their retirement assets. We run into that often where people are like, I don't want to touch the money, and they have this bucket of money sitting there. They don't want to touch it. They don't feel as bad taking $1,200 a month from a pension because that's owed, in their mind, it's owed to them versus I'm taking it out of my IRA. So there's a psychological.
Not only that, but when you take it out of your IRA, you have to pay taxes on it, and that annoys people, which then also creates many situations where it sort of falls under behavioral finance. You got people with these giant IRAs, and we're seeing it. They just become runaway trains because they don't want to take the money out, and it continues to grow. And the more it grows, the more they don't want to take the money out. Yeah. And next thing you know, the federal government's going to get a giant piece of that.
And we want to avoid that as much as possible.
Exactly. So that's pretty much it with this particular case study. So once again, just taking a look back at the beginning, what happened? We have a client who comes in, and this happens all the time. They have, we want to ask about A, B, and C, and then lo and behold, we uncover D, E, E, F, G, H, the rest of the alphabet. And, that's good, but at the same time, we're teaching them, and they really appreciate all of the information that they're gathering, and we're providing guidance. And trust me when I tell you, there's nobody out there who is going to be upset if we show them ways with which they can decrease their taxes. But at the end of the day, you meet their goals and objectives, and we're doing the right thing, and they're happy. Yeah. And that's it.
Exactly.
So,
let's do it.
Well, thank you very much for joining us again. That was part 2 of a 2-part episode for Jack and Charlotte of a case study. Remember, these are names to be changed, and we just use these case studies just for the sake of examples of stuff that we run into. We change the numbers, we change certain things just to create stuff that we could talk about. So, Nick, thank you very much for joining me for these 2 episodes, and look forward to seeing you next week. Thank you for joining my show. You have a wonderful day and week.